So I think the most notable aspect of markets today is just this growing valuation divergence that we're seeing. What's happening is companies that are perceived to offer high growth or are perceived to be safe, so have low economic cyclicality, are being placed on very high valuations. Whereas companies that don't quite fit those molds are often being priced incredibly cheaply. And what we've seen is that valuation divergence has dramatically accelerated since 2017. One thing we look at is just the pricing of what I would call the sure thing stocks. So these are kind of your safe stocks. So we can look to the US, a company like Rollins, so they do pest extermination. This business now trades on 45 times earnings. Similarly, we can look at someone like a Kikkoman who produces soy sauce, or Lindt chocolate. And these companies trade on circa 35 times earnings. So what we're seeing is very high valuations being placed on what are ultimately quite slow-growing businesses. The other expression of this excitement is those companies that offer very high sales growth, and really the software as a service companies are really the poster child of this movement. These businesses now trade on 20 to 25 times sales. We need to use a sales metric because they make no profits. And just a kind of a nice, interesting historical point, 25 times sales is where Cisco peaked out during the tech bubble and later lost 75% of its value. So these are just very high valuations, both in absolute sense, but also historically. So that's the anecdotal evidence, but importantly, it's also showing up quantitatively. So if you look at the data, over the last 34 years, the only time this valuation difference has been greater was during the tech bubble. So the market's positioning this way simply because investors are worried. So they're worried about an economic slowdown, they're worried about the trade war, they're worried about political instability. And certainly we're fully aware that many of the value stocks out there, they're not perfect. So their businesses may be more economically cyclical, or they may operate in a geography where people are worried, like China. So if we think about the investment opportunity landscape at the moment, on one hand we have these growth and safety stocks, there's a lot of crowding and they're trading on very high valuations. On the other hand, we have solid companies where there may be an imperfection, but they're trading on valuations so low that you simply can't ignore them. When we are buying, we're really trying to prioritise the companies that have long-term growth drivers. And a good example of this would be our semiconductor stocks that we've talked a lot about. The reason you could buy these companies on single-digit PEs was that the market was worried about the short term, so what are smartphone sales going to be in 6 months' time, what will the memory price be in 6 months' time. We have no edge in predicting those short-term moves, but what we can predict is that consumers will want a 5G phone, and companies will continue to spend money on moving their software to the cloud and investing in artificial intelligence. And if those things happen, it is highly likely these businesses will be bigger in the future. And what I want to emphasise is that while we're buying into value, we're also very mindful to keep a balance within the portfolio. So we own a number of growth and quite steady businesses. Good examples would be Booking Holdings, Facebook, Google. All of these businesses were bought when they were out of favour. And we're also holding a higher than usual cash balance within the fund at this time as well. So a common question today is, when will the market start rewarding a value approach again? And often the discussion immediately turns to how the situation of today may be different with low interest rates or other factors. And I think it's important to remember that a value-based approach won out during the tech bubble, it won out during the GFC, and it won out during the European sovereign crisis. And it did that because ultimately the return you get from owning shares is heavily dictated by the initial price you pay. And while it may feel uncomfortable that we're not getting rewarded by markets today, it's important to remember that the starting valuations on a large swathe of our portfolio are incredibly attractive.